get started in a few minutes. Good to see you. Nice to see you again, Josh. So I talked to you a few minutes ago. Thanks for joining. Lots of familiar faces here.
Hello, Trevor.
Good to see you.
Yeah. You too. And I was afraid I hadn't registered or something, so I was just registering. So I'll stop. So if we've registered for several sessions, so that we'll just keep popping up, because I did get some sort of a text message from you earlier today.
Yeah, you'll continue. You'll get lots of texts, lots of emails from Massive Capital. We want to make sure you never forget us.
Good. Well, top of mind. Well, we don't want to not show up when it's time to show up too.
Awesome. Then we got a great turnout tonight. We just give it a couple of minutes.
All righty.
Welcome, Selchuk. It was good talking to you today as well.
Hey, Mike and everyone. Yeah, it was really nice to talk to you. It's been a while. Yeah.
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 Yeah, this is kind of a moving party, isn't it?
Yes.
Oh, yeah.
But it's a good party. That's a good party. We're helping each other out. That's the idea of networking. You give, and then you get.
All right, Mike, whenever you're ready to get rolling. Okay. We will have plenty of time at the end for Q&A. Feel free to put any questions in the chat, and if it's appropriate, we'll answer them at the time.
So what are you planning on, about an hour?
Yes, sir.
Okay, good job. And Kenton will work fine.
So we usually plan on an hour for the primary session, and then we have the after party that anybody's welcome to join us on after that. So.
Oh, okay. We like parties.
There you go.
Yes, we didn't get enough over the holidays.
Yeah.
Although we had a very good New Year's Eve party. That was fun.
We have a full house today, Mike. It is all you today. Barton's on you.
Yeah. It's a team, man. It's a team.
And after yesterday, then I was thinking tomorrow is Friday. Then Bo was like, "No, tomorrow is Thursday, right? You have one more day in Houston."
Yeah, we still got a lot of time left in this week. I was kind of struggling with the same thing. So here we go.
All right.
Then I'll let Trevor kick her off for us. Thank you.
All right. We want to thank everybody for coming to the Massive Capital Wednesday webinar. We do these every Wednesday. The purpose of these is to build a good investor community, to be able to offer lots of good information for everybody to learn from. We are not offering financial, legal, accounting, any advice like that, investment advice. You always want to make sure you get your own. What we're talking about is what we feel, what we believe, and what we're seeing in the marketplace. So again, welcome for coming. These are always recorded and loaded on our YouTube channel as well. All right.
Sorry, Trevor.
Yep. So there we go. The educational series. Everything carries risk for investment, so please use your caution and discretion for any investments.
By the way, what's your load up time for YouTube?
The next day. Yeah. And if
the next day,
muted and just put questions in the chat, please.
Yeah, okay.
I think Trevor, you muted yourself, buddy.
Muted myself. How about that? Thank you. So tonight we're going to talk about who is Massive Capital. We're going to talk about partnering opportunities with Massive Capital. Tonight is our case study, which is called 7 Steps to Passive Investing We Need to Take. We really kind of wanted to start the new year a little bit fresh. We ended with some education, but we thought, let's go right back to the beginning about steps someone would take to make a passive investment. And then, of course, there's always time for Q&A. That's the best part of the evening. So Massive Capital itself is a vertically integrated company. We are located mostly in Texas. Most of the principals are in Texas. So you can see we have properties Houston, San Antonio, Austin, and Dallas. We also have properties in Colorado, Carolina, and Georgia. You'll see the Phoenix in Arizona. We do not have properties there yet, but we're looking for development, retail development deals. So if you look on the left-hand side, you'll see Massive Capital's involved in raising equity. We also, through our partners with Realty One, we have a brokerage, and that's a brokerage on triple net leases. So development, retail developments, lifestyle centers, things like that. Same with the property management. We do development, and the development is both in construction, which is metal, which again is more industrial or retail. And then construction wood is something that we're moving into, and that is more traditional builds. And then, of course, Massive Capital has an education program. We did do several webinars about our education program. We will put links in the chat for those that are interested. So our partner Realty One has about $290 million in real estate. They own just under 5,000 square feet of retail and about 250,000 retail center. Yes, those are two types of things. And then, of course, Massive Capital is mostly multifamily focused, but we do have a development deal and X-Space, and we are partners on the Realty One with a shopping center here in Austin. And so we have a total of $175 million under asset. So again, this is awesome. When you think about it, we're getting up to that $500 million mark, which is super, super. So triple net is where the tenants are responsible for paying all of the costs. So a triple net lease means that the tenants pay their own insurance. Anything that happens on a triple net lease gets split up amongst the existing tenants. Great question. So our team is expanding. Brenda is still in the witness protection program, even though she's got her camera on here. We need to get a photo of Brenda in there. So, but you can see our team is getting quite large. Across the top of the folks that you would deal with on a regular basis, myself on the investor relations team, Jasmine, Maria, and then Candace, and then you'll also be dealing a lot with Brenda on the education, and a lot of our folks deal with Ellen as well on underwriting and deal sourcing. But you can see all of these folks here. We are totally vertically integrated from construction to leasing to brokerage to everything. So it's really impressive to see the size of the team now. And then we have the principals. So we have Sharar, who's on the call tonight, and Mike at the bottom opposite end. Also Sanjay. And then from the Realty One team, we have Bo, Alexis, and Pat. This 6 people form the whole leadership team for the combined group, which is called Massive Capital, or will be as soon as we get everything done in the next few weeks or so. But it's very exciting, and everybody has a unique role, and it makes for a really, really good working environment. So everybody has a specialty. So it's quite interesting. And for those of you that don't know Sanjay, we were bragging on him. He actually just hiked just before the holidays, Mount Kilimanjaro. So it's pretty exciting to be able to be with someone who's done something that spectacular. So go ahead, Mike, and the next one.
Yep.
So this is a list of all of our opportunities of things that we've done with Massive Capital. So we start at the bottom. Our first one was a land development deal just outside of Austin with 10 acres. We're going through the entitlement process right now. Amberwood Apartments in Dallas, Warner Robins in Georgia. Then we raised money for a new development called X-Space in Houston, which is actually about to start construction. We have our second asset in the Denver, Colorado market. We have a triple net lease, again, that N, so it's a retail where the tenants pay everything in Conroe. We have a new development in Katy, Texas, 11 acres. We closed on a value add multifamily in North Carolina. Also purchased 10 acres. And this is a little bit different. This is industrial development, which of course is very different than retail, has a different purpose to it. And then we just closed on our triple net lease retail, 16,800 square feet in Austin. And we're also starting construction on that this month. And then if you go, we have an LOI pending on a couple of opportunities. And right now we are currently raising for a 506C, which is for accredited investors only in San Antonio. This is an awesome property. Later, we'll put in the chat next Thursday. We are having a webinar on this opportunity, but you can reach out to any of the Massive Capital team if you would like to get some information. But we're projecting an 18% IRR. There is a 7% preferred return. So for those of you that aren't familiar, it means that the investors get the first 7%. And until you've gotten that, the sponsorship team, it doesn't get any payments. And we're estimating a 2.11 multiple equity multiple in the 5 years. So it is a 506C opportunity. As we mentioned, it's 204 doors in San Antonio. It's a great opportunity in a great area. So we're really excited about getting this one closed this month. And Mike posted in the chat, there's a link that you can sign up for. And if you register, all that does is give you access to our deals on the portal. There is no obligation for you to invest. It just gives you access to be able to see everything we have. And then, of course, from there, you can make a call with one of the team just to ask any questions about our opportunities. So this one we're super excited about. We've spent close to a year getting this deal wrapped up and ready to roll.
Yeah, but meaning a year, meaning not that was from the first time we made an
We meant
offer.
it, yes. Yeah, so it didn't take us a year to close, correct? So it took them for a year to agree to our offer price. How about that? So we got this for a really good deal, about 83,000 a door, which anybody that knows in the area, most of the properties are well over $100,000 a door. It's a great opportunity.
So excellent. Yeah, and thanks, Trevor. So it actually, that shows as well a sign of patience in the process as well, that we are not just going and picking up any deal anytime. We're looking and being selective as we go. So even though we closed 10 deals in 2023, we closed 8 deals in 2022, so a total of 18 over the last 2 years. But take into account, we also, during that same time, we underwrote last year over 500 deals, and I think we talk a little more about that as well. So, sorry, here we go. Oh, here we go, and that opens this slide,
so
right?
Mike, why don't you go ahead and do this slide here?
Okay, thanks, Trevor. So as I was talking about, the fact that we closed 18 deals over the last 2 years, but we also underwrote a number of deals during that same time. So nearly 500 deals we underwrote this last year. You see here 428 in 2023, 160 in 2022. It just shows the process and progress that we're continuing to make, both in asset type and the volume that we're able to get through. We're adding a number of things to our process, including, don't know if she's on tonight, I've not really checked, but Ellen Bronkarts is doing a lot of the underwriting with Sanjay, bringing in all the deals. We're working in a new system, Monday.com, so that we can monitor and move through things more effectively and quickly. And if anybody has a deal, please, send it with some details to deals@massive.capital. If somebody wants to share that in the chat as well, deals@massive.capital. But, please send us your underwriting, what you think the deal is worth, what you want to do with the deal, and any of the financials, T12, rent roll, and the OM if you have it, so that we can take a look at it. The other piece is that we're very active in also text campaigns and our email campaigns over the last year. So sent on approximately 9 million emails and about 1 million texts over the last year. Now, we may actually do less than that going forward or similar, but we're also looking at being a little more active in our, proactive in the types of communications we send out to y'all and everyone else that joins us. So And then let's talk real quick on how that ties into how we partner. I talked about deals at massive.capital. You can send those, so we partner with landowners. We want to JV with them and do deals where we are the construction company, as Trevor talked about in the beginning, and in the development side. And we can, go through the whole process as well of the up through lease up and operations and manage the deal. So we love to, go into those as a joint venture, and the land becomes the equity LP part or GP part for the landowner. We also, on multifamily, want to, look at opportunities to partner. Asset management, where we co-sponsor and provide that oversight as asset management. We now have an in-house asset management software tool. Kind of think of it as a portfolio management as well, not property management. So it ties together with all the property management software and brings it into one space that you can look at all of your portfolio, your individual assets, and we have a full-time dedicated team for support for that as well. So we offer the asset managers and the tools into that opportunity. We do as well the CapEx piece of projects that we co-sponsor, especially heavy CapEx, which ties into the whole discussion earlier about our in-house general contractors, GC, and our construction company. And then credit enhancement is a term that maybe you have or hadn't heard, but it's basically we offer the opportunity of, the balance sheet being a KP on a deal, liquidity, and that experience that a lot of lenders require. Even if you've got the balance sheet and liquidity, if you don't have experience, some of the lenders still shy away from that. So we offer that as well. And then, as Trevor mentioned, our education program, and I think Brenda shared as well, but we have a CRM, which basically mimics everything that we're doing. It can allow you to send out your 9 million emails and 1 million texts if you want to. That's available. It comes with the website, the CRM and automation built in, and our GP Accelerator program. So we facilitate, our students and partners to become GPs within, typically 3 months. I would say, up to 6 months, and then, it's a 1-year program that, so if you go to that massive.capital coaching, it'll show you a little bit of that and the opportunity that we offer for people that want to accelerate themselves into being GPs with us and to do their own as well as they go forward. So tonight, we're going to talk a little bit about, as Trevor said, the 7 steps to passive investing that we need to take. And I'm going to let Trevor, you're going to take off this first ones, right?
Yeah, I can definitely start the first ones. And, this is basically what we decided to sort of picked up on a few terms. You can click the next, I think it fills in here. So number 1, most important thing, right, is to learn the power of passive investing, right? So you need to get educated. That is part of the reasons why we do these Wednesday webinars, offer a lot of materials, as I mentioned, on our YouTube channel. There's lots of information. So you need to learn the power of passive investing. And then in step 2, you need to find the money, right? You can't passively invest if you don't have the money. So you need to be resourceful and think where the money is. You can save it from your salary. Sometimes if you've switched jobs and you have an old 401k or a retirement plan, you can move those into self-directed, and you can be able to use those funds to be able to invest in it. So you need to find a sponsor you know, like, and trust. So again, part of the reasons why we spend a lot of energy educating people, we want you to get to know us. You need to find a sponsor that you know, like, and trust. I personally have been passively invested in 20 syndications. general partner on 11 syndications, 8 of those with Massive Capital. And who you give your money to is as important or more important as to where you put your money. So it's super, super important. Go ahead, Mike. So decide what type of investment suits you, right? There are a whole variety of investments and they all have a different reason. So you need to decide what's important for you. What do you really need to get? And then you need to understand your investment, right? So every investment has nuances. So there's value add multifamily. We've talked about new build retail. We've talked about development. We've talked about industrial. We also did the X space. So you need to get a little bit of an idea because it's a balance of risk reward. And it's also the time use of your money and when you may need to make that money come back to you. So clearly development deals, there's no real cash flow, but there's often a good multiple of your money. Often with value add multifamily, starts off a little bit slow in the cash flow and then starts to produce it. And again, the money is made. So you need to look at and understand exactly what you are investing in. And then step number 6 is just do it, right? As if we're Nike. At some point, you're going to reach this point where you're going to be in analysis paralysis. I spent a lot of time there thinking and wondering because it's a big first step. So at some point, you just have to say, okay, I've done my research. I'm ready to get moving. And you just have to make that decision to do it. Yes, it's a scary decision. Yes, you need to spend some time learning, knowing who you're giving your money to. But until you make an investment, you're not a passive investor. You're not a real estate investor. And then the final one, step number 7, which is the most important one, I think, is you make money while you sleep. Okay, so that's a statement from the great Warren Buffett. But if you think about it, most of us spend our life on the Monopoly board. We're going around and around, and every 2 weeks, every month, whatever it is, we collect our paycheck, we do our different things. And that is you working for your money. Until you start passively investing your money, then you let your money start working for you. So you're in bed, you're sleeping, and your money continues to work. Someone else is doing, and we'll talk a little bit about somebody else is doing it, but there are a lot of varieties of things that you can do. And Mike did answer the question. All of our offerings that we have are regulated by the Securities and Exchange Commission. We do some joint ventures, which are slightly different. Our deals normally start out as a 506B, which means that we have to have a previous existing relationship with you to be able to invest in those deals. So I put earlier a link for you to book a call with Massive Capital. Until we get that relationship, we can't send you those deals. Okay, and so you may miss out on a lot of opportunities. Then like the Horizon deal, what we did is it switches to a 506C. So we can talk about it openly here on this webinar, but you must be an accredited investor to invest, which means you have an individual income of 200, a family income of 300,000, or a net worth excluding your house of $1 million. Again, that's a very broad way to look at it. And joint ventures, you have to send us a deal to massive.capital if you're looking to do things. We're mostly looking for landowners that want somebody to develop their land.
Yep, there we go.
All right, Mike, you want to go through the steps?
I know you go ahead, Trevor, for a couple slides. I'll jump in.
Okay. All right. So learning the power of passive investing. Okay. The benefits of passive investing in real estate are abundant, right? It helps you to scale and go bigger and go faster. So if you think about it, a lot of people start out real estate investing, single family homes or whatever. I always refer to that. While it is real estate investing and you're definitely earning money, what we're talking about here is your money working for you, be able to leverage the power of a larger group. So as a passive investor in commercial real estate, you'll pool your money together with other investors You purchase even a larger, more stable asset than anyone could afford or get a loan for on their own. And as an investor, you not only receive passive income, you receive appreciation from the property, and there's also tax benefits, risk diversification, and increased buying power and more. Okay, so on the right-hand side, so you see the little model, right? Passive investing, convert your time into cash, and then you take that cash and you convert it into assets that are producing income without your time. The without your time is a critical piece of this. So if you think about this, okay, let's go back again to our deal in San Antonio. It's a $16.9 million deal. Do you ever think that you could own a piece of a $16.9 million deal, that you would be able to get all of the benefits of it, and then someone else like Massive Capital, we're buying it, we're securing the debt, we're taking care of the management, everything to do, and we're the steward of the investor's money. So just to give you a little bit of an idea, when Horizon Apartments earns $1, 70 cents of that dollar goes to the passive investors, and until they've received 7% on their investment accumulated, us as partners, we receive nothing. Then once we reach that threshold, we start collecting our 30 cents on that dollar. So again, if you think of the power of this as the passive investors coming in, so we're buying a $16.9 million apartment, we're raising $6.6 million, but that $6.6 million owns 70% of that asset. You actually have an ownership in that asset. So you're able to put your money, and if you think about it, who would ever think? I never would have thought 5, 6 years ago when I started doing this, I never would have thought that I would own a piece of something that large and then be able to collect and have some of the profits that come in. So that's a lot to do with the power of passive investing, right? That you get to pool your resources and get into asset classes or get into things that you could never, ever achieve on your own. And someone else who has experience, who has systems, who has a team, takes care of the work for you. So step number 2, find the money to invest. Okay, sounds simple, right? So you work and you save, then you save to invest, you invest to create passive income, and you repeat until you can skip step 1. Sounds kind of intuitive or simple, but it's really quite true. Until you can produce enough income from your passive investings, you will still need to continue to probably do step number 1, which is work. So this is the way that you're going to generate. I always like to talk about the story about how the power of real estate, it's not a get rich quick scheme. I want to make sure people understand that, but the power of it is amazing. So again, if you think about it on our Horizon opportunity, we're talking about estimation of doubling your investment in 5 years. So if you put $100,000 in it and it became $200,000, and then 5 years later, you invest $200,000 into another deal, it becomes 4, then it becomes 8, then it becomes 1.6 million, then it becomes 3.2 million. Think of the power of you worked and you saved and you saved, and then you continue to repeat that until you can skip step number 1 and no longer need to work. Your passive investing does it. So you're going to ask a sponsor for examples. They'll accept less than a minimum. So sometimes if we have 50,000, but sometimes we might accept less than a minimum. You can pool your funds with some other people. So we've had some people that have come together and said, okay, we're going to put in 5 people are going to put in $10,000 and create an LLC. And then obviously I mentioned it earlier, there's a huge amount of power if you have a retirement fund not on your current job. It's almost impossible to be able to invest through your current job. So it would have to be an old one that you would convert to self-directed. And then again, you can invest in that. And depending on what type of retirement fund it is, so if you've already paid the tax and it's a Roth, you would continue to earn tax-free. If it's not, and again, I don't want to make tonight too complicated, but the real thing is that you understand work to save, save to invest, create passive income, repeat until you can skip step number 1. Sounds simple, But it is, you got to get started and you got to think through that.
Second, Trevor. Okay.
All
Trevor,
right.
let me pick up here a little bit.
Go
for
ahead.
you. Yeah. So, it's steps 1 and, 2 critical in the process. So, step 3, and I'll share a little bit about this as well, is, find a sponsor like and trust. So this is like the perfect example of why, we come around. We want, you to get to know us and us to get to know you. So everything we do, is not just, so part of it towards education, part of it towards creating that relationship and getting to know you and you getting to know us better. Think about that first, those deals are sort of like marriages, right? You're investing into a deal, an asset, a property with a team, and you're going to be invested in it for 3 to 5 years. So that's like a, long-term investment, like a marriage, right? So you want to be sure everything is aligned in your goals and your values as you go through that and vetting those sponsors. Look at what the sponsors, look at their deal flow. What's going on? How many deals have they done? What's their existing deals? What are the type? Have they been able to close? How strong has the relationship been of the deals, the closing, the lender? So there's a lot of things that the sponsors have to work through and show that their strength in order to be able to do the types and number of deals that are out there. Then, think about, we talked earlier, running the asset, right? So what does the back office look like? What does their reporting look like? How often is the reporting coming out? How good is the reporting? How much are they getting into some of the financials? And how involved is really the sponsor team in the asset? Are they actually going to the assets? Or are they performing this all from afar? And we see and believe, like, having you have to show up, right? The team, it's like any other business. You there's a level that you can run from afar and trust, but you still need to show up and be there, on a regular basis, a consistent basis. And when things may not be going as expected, you maybe need to be there a lot of the time. So you need the commitment of the sponsor. The other is, what is their, involvement? Not just involvement, what is their time commitment available? So, if you have a sponsors, in our case, all of our team is full time on the not just the asset management, but full time on massive capital. So the availability and the time of them to go and do this is there versus somebody that's got, their W-2, they don't have all the commitment, they may have to go do things. So think about some of that as you go through that. Check, who has invested with them in the past, who's, use that as part of your due diligence as you go. And do the sponsors, are they investing in their own deals? How much are they doing with the deal? So you'll see a lot of GPs that are putting in, 10% of the equity into the deal themselves. So that's something else. Or, are they riding with you through the process? So let me see. And yeah, so those are some of the key things. And, I think the more time you spend with the sponsors, the more you learn about them, the more you get to know them, and the more comfortable you can be with them in the process. So step 4 is the type of investment that you're looking for and what suits you. So there's three different ways that I look at this, or we, would say consider in the process. Is so there's asset type, which is over here on the right. So the asset type is, okay, is it multifamily? Even within multifamily, is it value add? Is it new, class A, class B, class C? And how is the multifamily, what is the plan for that multifamily? Multifamily typically is going to be then something on, when we talk life cycle, is going to be something that's, 3 to 5 years. Right now, I would say mostly you're seeing 5 years, maybe even 5 to 10 years in some cases. New development could be, now new development could be for multifamily, new development could be for mixed use, meaning it's multifamily and retail, or it could be for retail only, or it could be industrial, it could be storage. So new development has different timeline and different risk and returns as well. So the new development has typically a little shorter timeline, 2 to 3 years, depending on the type of development and what stage you are in that development. And as well as the risk could be slightly higher in some cases just because of the unknowns of what's going to be the the approvals, what's going to be the rent rates when I actually make it go live. But the returns are usually correspond to that to be a higher return at the same time. Retail is the triple net assets that was talked about earlier. And then medical office buildings is another asset class. There's others, there's many others, storage, industrial, other, motorhome parks, whatever. But these are the focus for us, as well as multifamily, new development, and retail primarily. And I talked a little bit, so the return type, each of these has a slightly different return, both in total value and time of return, which that affects the IRR. So a new development maybe has a much higher IRR because it's a shorter time with about the same annual return. Cash flow may be what's important to you as an investor. So like Horizon that we talked about earlier will have cash flow to investors in year 1, and then that increases in year 2, 3, 4, and 5. So, you may be looking just, if you're looking strongly at, hey, I want to be sure I've got cash flow every year, versus waiting till the end of the deal to get my return. So that's another thing. And then tax optimization is typically looking at the depreciation. So Horizon, which is closing in 2024, falls under now a 60% bonus depreciation accelerated. But even at that, the opportunity in the year 1 is about, it's close to 40% of depreciation that people will get for Horizon as an investment. So if you're needing depreciation, which is part of the tax optimization, that's a reason you would look at something like that. Step 5. So understand your investment. So where are you, this comes back to the type of returns you may want. Where are you at in your life? And what is it that would affect your decision or your investment type? It comes back to, do I need cash flow, or am I okay to just let this money sit, appreciate, and return? Okay, I'm going to get double that investment in 3 to 5 years. Understand, how the returns work and how they're calculated, and there's the return, of capital versus return on capital. I would guarantee that the majority of every deal out there is a return of capital. But most people also do not exit people out after the capital is returned. So in a way, you actually receive your capital back first, and then you continue to make money on the deal, which means now it's an infinite return because you have no capital in the deal and you're continuing to get your cash flow or your returns. So if somebody's able to do a refinance or something, return some of the capital, you're already getting ahead of the game in the process. Every deal is different, you know, we've talked about that. It's, you know, what is, again, it really all comes back to what's your goals in your life and what are you looking for to 2x your money, you know, and is that like generally 2xing your money every 5 years? To me, it sounded a lot more interesting than what I was seeing in bonds or stock markets overall. And then I talked about the IRR and that higher return, you know, the more desirable of the investment, you know, and that's why, you know, we focus on IRR and ours, we focus on the cash flow and we focus on the multiple as you're looking at your investments. And now I'm going to step this one back to Trevor to just do it, Trevor.
Yes, so
I'm
just
going to
do
mute
it.
myself because I got something going on here. So go ahead.
Okay, awesome. So I know it sounds like a Nike commercial, just do it. But it's super, super important at some point. If you don't make the decision to do it, you will never be able to get to the next level, right? So don't be stopped by analysis paralysis. Making the best decision sometimes is as simple as doing it. Nothing is ever perfect. So the next time you feel stuck, keep that in mind. Again, keep asking clarifying questions, continue your education, but you want to got something going. If you look at all successful people, they start before they are ready and they figure it out as they go. Now, again, what we're not saying is be reckless, do different things, but at some point you just need to be able to go ahead and do it. You'll be unsure, you'll feel you're unsure, unprepared, unqualified, but I can assure you that all the planning, researching, and delaying, revising in the world will not make the decision any easier. Okay, it's very, very difficult. So again, if you look at, you go this little vicious circle, right? If you just keep going around and around and around, and you never start your journey. Again, I didn't start my passive investing journey till well into my 50s. I spent a long time going around that monopoly board. I was paying somebody else rent. I was working for somebody else. I was doing everything. And again, if you remember, real estate, time is your friend, right? Your money grows over time. You get the depreciation, you get all of the benefits, but it's super, super important. So I want to make sure that everybody gets that point. And Mike, maybe if you can click into the next slide, we're almost at the finish line here, folks. All right. So what is passive income? It is income that is produced without your time. This is as powerful as your money works for you. You are not working for your money. All right. And as the great Warren Buffett said, if you don't find a way to make money while you sleep, you will work until you die.
Excellent. And sorry, I was trying to get down.
All right.
So and I'll talk a little on this, Trevor, and then let you share, and then we're just open for Q&A after that a bit. So, you know, for everything in, you know, for us, multifamily is a team sport, right? And there's so much of it that you need, you know, if I try to accomplish some of these tasks on my own, you know, I'll end up either on an island stuck or can't get across the bridge because there's too big of a gap. And, you know, I need, you know, help as I go through the process. So just wanted everyone to think about that. And the reason I mentioned this comes back to, you know, the opportunity to join with Massive Capital, come onto the education program, which allows people to quickly become GPs through the process. We, you know, give you the guidance, the mentorship, and the deal. So one of the key things we have is we have the opportunity for people to join us and join on the deals that we are doing as we're going through them. So many of our students already are partners in many of the deals we're doing that we did over 2023 and going into 2024. So I will pause there. And then, as I said, we talked about send us deals. If you have something, if you want a JV, send that, talk to, deals at massive.capital or Shariah, Sanjay, Trevor, any of us on the call tonight. And we'll stop there. I think I was trying to go through the questions in there. I think you guys
Man, there's a
covered
lot of
everything.
questions tonight. Tonight's a great night. And I want to make sure I'm clear. All right. When we talk about just do it, I want to make sure everybody clear that was the 6th step. We're not saying just go off and invest your hard-earned money, right? We put all of those steps in advance. It is super important that you get educated. You find a sponsor that you know, like, and trust, and we could make a whole session on what does that mean. You want to look for people. We kind of skipped over it. I say it's like a marriage. You're going to be together for 5 years. You want to make sure that they have the same values as you, that they care about their tenants, they care about your money. They're investing alongside of you. That's part of the reason why we put the pref equity where our investors get paid first. We only get paid on performance. Many of your other investments, they get a fee whether you make money or not. And again, you're not able in the stock market normally or different things to invest in real assets that are performing and are giving what we need in America, which is affordable housing. So it's super important. These questions were awesome. I have a feeling we missed some. So I don't know. I think we're pretty much done. Again, these happen every Wednesday. The total goal is to offer some sort of advice, some sort of education, something that you can learn from. And the real learning starts when you start asking questions. And again, tonight the chat was on fire. I couldn't keep up. I was trying to make sure I did all the answers. So if we miss something and you have a question, just feel free to unmute yourself, ask away. We normally stay till about 7 with the recording going, and then we shut the recording off so that we can feel more comfortable and ask anything. So again, these sessions are only as good as your questions, because that's where all the magic is. And I don't know, Shariah, sorry, I didn't even let you should go ahead and finish. Shariah usually tears this up, and he says about 3 times what we say in the same time frame.
Messed up, man. Y'all put me in a very tight spot. No, this is good. Just to kind of go back to that comment, nobody should do anything blind. And within the massive, they're just saying, friendship second, skill first, right? It's not the friendship first or relationship first, then the skill set, right? So we're investing our hard-earned dollars. We're taking others investing on us. That's a big weight. And so when you invest, make sure you check all the boxes, go backwards, follow them, hear them out. Once you listen to folks 4, 5, 6, 7 hours or so, you'll get a rhythm of it, who they are, and do your due diligence as much as you can. Then you'll come to a point where you're going to hesitate. And I was like, I've done my work. I feel it. But, the whole portion of making the jump, and then what I would say, whoever you like, go talk to them and let them know your feelings. There's always a way to bring somebody else in. So from the massive perspective is we want to enable everybody, whoever we can. It's oftentimes, even though we have thresholds of, minimum dollar amount coming into the deals, and if someone says, hey, I like it, I get it, everything is fine, I can do the investment, but for the first one, I just want to take a little bit more lesser risk, right? Or just to kind of get your head wrapped around a good spot, we can always take a lower dollar amount. So point is, at some point, you have to decide to do it and jump over the fence. But up until that point, do your due diligence, and from the marriage side, this is my joke. I'm 42, been married for 17 years, right? If we were to go back and get to know somebody, I'll take them to on top of the Mount Kilimanjaro when it's raining, when it's cold, when I'm running out of food, and I want to know them at the very stressful scenario. Then we get to decide, do I feel like being your friends or not, right? And being a sponsor team, it's just like that. Multifamily is fun, it's beautiful, and it changes life, but it takes a lot to get there. So pick the team, see them backwards, see the back office, see who they are, see where they came from, what they have done in the previous life, how they're replicating in this domain, look at how their skill sets are going, and then go back and invest. And if you get stuck with it, that's fine. Call one of us, we'll push you guys on the other side of the fence.
So it's kind of interesting. You made me feel old. So you've been
No,
married, you're 42 years old. I've been married 44 years.
damn, man. I mean, today I met John. John said, I've been in Houston for 50 years. I was like, damn, I made it halfway through 25 years. Anyways,
That's awesome.
Yeah. Any questions? Feel free, just unmute yourself. Don't be shy. Put it in the chat if you're shy.
Yeah, I was gonna say, if you are shy, put it in the chat and let us know the question, and you
hey, if
know,
you're shy, make a way to kind of go online
but
and ask the question.
I see,
but
I
but
see
that was
3
going to be
people.
my next step. Thank you, Shariah. Thank you. I think that's one of the things I struggle with, and I think one of our, some of our partners have shared is, one of the things about getting to be known and being known is participating and asking the questions, and people see you ask the questions and talk, and they get to know you better that way. So please step out, get out of your comfort zone, and ask a question, please.
This is awesome. I see 3 people that had calls with today that joined us tonight. So thank you.
So, hi, this is Ken. Can you guys hear me?
We can.
So I did actually put it in the chat. You may not have seen it, but curious on, particularly in multifamily, and it may apply to others, but what kind of data analytics tools are you guys using to assess those deals?
Go ahead, Shar. You can see him
Ken,
smiling.
we're about to be best friends. So it depends. So depending on the asset type and asset class, so everything so our biggest tool that we use is RedIQ, and underneath that we have 2 different kinds of model depending on your dollar size. So if a deal comes in, we have some KPIs to take a look at it and see if that ballpark. So we have a 1-page simple back of the envelope underwriting that gives us a threshold of whether it's a okay or below the investment threshold or above it. If it's okay or above it, then we'll bring it to the RedIQ. Once you go to RedIQ, we kind of sort of understand the asset a little bit more. Then we do a template or model with our synthesis. And up to $10 to $15 million, we'll use synthesis model. Anything that touches above a synthesis model, we have a detailed one, and that does beautiful modeling, and that comes from the RedIQ, and we use that. And when we go to lender, we give them a whole package from 1-page strategy to all the assumptions, execution plan, then the RedIQ model, and then we go. But the RedIQ is our tool. We've been using it for a year and a half now. We love it. So
that's a commercially available tool.
That's correct. That's a very
And then
expensive
it
tool.
sounds like you have a number of other secondary kind of internal models that you've built. Is that true, that are massive capital IP?
No. So we use off the market product. Sometimes it's a who not how. So we use our basic model that we use. It's called Synthesis. That's a template you can buy for like, I don't know, $150. We bought one, we use it, we like it. And it has some nuance limitation, but we can get around of it. So Synthesis, it's a model. If you need a template, just email one of us and we'll give that to you. No problem at all. And then beyond the synthesis, we use the RedIQ. RedIQ, we use it because, I think one of the slides we showed, we underwrote over 400 properties. We want to collect data, and also what we see, most of the folks know how the Excel works, but within the Excel, there are a lot of assumptions that we make. And with the RedIQ, the way we analyze the data, that cuts across. So we make a standard way of looking at the historical performance of the information, and then we store it. So right now, oftentimes what happens, we ran so much of information. If I go to a certain zip code in Dallas area or Houston area, we have actuals from that location before we underwrote so many deals, right? So we'd like the RedIQ because of the data deposit and also the standard way of analyzing the historical performance. And it also pushes out a extremely high-end or detailed underwriting. But underneath that, we use synthesis for all things.
Okay, appreciate great explanation. Thank you.
And so a question here in the chat, Sharar, is what are the biggest risks for a new deal, multifamily, things to consider. You know, as a new person, what are the big things that that in your mind? I have my few, you know, which again is, it takes a little bit of education. To everybody says they have conservative underwriting, right? I've never said, listen, we're a bunch of crazy people and we got crazy numbers, right? I've never seen a deal that says that. So, but what are the things that you look for, and that obviously we present when we do? Because you know, we looked at 500 deals and only did a few, because those are the ones that made sense.
Yes. So if I'm an LP, and I will start with the team, right? It's just like buying a stock. So think about it. I'll give you a go back. Market is efficient. That means if you know what I know, then price is level headed, right? But when you buy a stock, and for folks who is to do with us trading, one of the biggest things that we take a look at it, whatever that the 10K they're going to supply, which is our underwriting. On top of that, who are the management companies? So for me, coming from Shell, M&A strategy, whatever you call it, I start with the team. And the first thing I do, I send everybody to the hospital for 6 months, and then ask the question how my deal is going to run. What happens if the asset manager gets sick for 6 months? God forbid, how my assets will perform, who's going to take the lead, and then ask the question, do they have time? Right? Between the sickness and the time, half of the deal goes out the door. Then we ask a question, okay, how well do I know the person? Right? And then we look at the GP's total performance, right? If a deal is 85-15, if a deal is 90-10, like 90 LP 10 GP, I get extremely scared. That's a skinny deal. It's a financial designing. The GPs are going to be doing 10 different deals to make their living, and that's a dangerous zone, unless it's a class A and private equity company, sophisticated, $50 million deal, I'm okay. But then 85-15, so 90-10 for us, it's a no-go as an LP for me. 85-15, I'll think about it. Probably not. 80-20, it's in a yellow zone, but 75-25, 70-30 split, where I feel like GPs are committed enough to push the performance, they're going to dedicate the time. So that's on the GP side. On the LP side, the question we ask, what's the value add? That means if I pull the actual performance of the current data, and if I look at the pro forma, I look at the spread, that how hard I have to work to get to the pro forma number. And if it is further the gap, depending on the asset type, it's more the questions, right? Because we live in a zone where everybody knows almost everything. And if I'm charging $1,000 and my pro forma is $1,300, the gap is too wide in today's market, unless I'm buying from a 90-year-old grandfather, right? It's just tough. So from the assumption perspective, I always take a look at the spread between the as-is rent plus to-be rent. Then if I understand how we're going to close the gap, deal to me is investable, right? At least it checks the boxes out. So I start with the GP, and whether they're one-man show and have 50,000 properties, or there's a team, got back office, and they are getting paid because it's almost like us as LPs. We are hiring the C-level team to run a company worth of 50 million, 20 million for 5 years. They need to spend their time, hence they need to get paid, right? I'm not hiring the folks from HCC. I'm hiring from folks from U of H, UT. They have a certain salary to make. So we make sure the GPs are there. Then on the assumptions, the biggest assumption is that we always forget multifamily, it's a revenue game. We're not going to win by cutting the cost. So cost got to be efficient. We cannot be the cost, best, right? We cannot be, just too many moving particles, right? So as long as you're cost efficient, but I have a good grasp of the growth in the revenue, that's a good deal for me to go invest in. So, and that all comes from how many deals that you underwrite. So study first, do some testing, and then simulate as if you're investing, do some cross-reference. Once everything checks out, start with the GP, and then go to the LP and focus on the revenue.
Awesome.
That's a too long of answer.
And obviously right now, fixed debt is huge. A lot of deals that are in trouble didn't have fixed debt. And so you got to be very careful that your debt interest rate is fixed, or you have, because that's where a lot of the deals that are currently in trouble.
So it's on that note, right? It's how should I say it? From the massive side, our philosophy is that every cycle is a cycle to buy, but not the same way we bought in the previous cycle. as us as an operator, we are in a sense money managers. We need to be a macro guys in growth and micro guys in growth, right? We need to know finance and the market trend. We may not know which way we're gonna go, but hell, we gotta know where we at today, right? I mean, folks who come from single family, you know, you don't on the hot market, you don't buy something from MLS and try to flip it unless God gives you a gift, right? COVID. And so it just we have to understand which way to do it. The way we structure something on the top end of it, which is on the top end of it, you want to stabilize everything. When the bottom falls out, you're still holding your ground. So you should not do higher leverage. You should not do bridge debt and floating debt when you're on the top of the market. A lot of folks have done it. But then when you're on the bottom of the market, you want to leverage up as much as you can. You want to get as much of a floating debt as you can because I'm at the worst place. Everything gets better from now, right? And so it's a vice versa. So for us, again, it's a finance, we are in a value creation business. We are a finance company, or everybody who does operations, they're in a financial, forecaster. So make sure you know the macro, you have a good understanding what cycle we're in, then protect your investments as you go. And as long as we are on the side of the market, and we'll take a little hit, but we'll come back out on the good note of it.
Thank you, Schreier. And a couple other things, couple sort of housekeeping things. Trevor shared right there, you see at the bottom of the chat, there now is the YouTube channel for Massive Capital. Go there, subscribe, and get access to the replays there of all of our replays. And the second one is a reminder of we have a virtual live event coming up February 16th. I put the link there, Massive Multifamily. Go and events. Go there, sign up, please. We'd love to have you all join us. We'll be going into more detail, more depth about a lot of subjects, and we'll have a lot of different additional experts and partners than just the Massive Capital team joining there. So go there, sign up. It's free to get started.
And just because you're all special, there's a code. If you want to get to one of the paid prices, you can get 50% off because you're a VIP. So you had no idea showing up tonight would give you that nice status. It was the good questions tonight. I feel like we're getting somewhere.
So I thought that Brooke is asking there, I thought that answer or that question was answered. What are the biggest risks for new investors?
Yeah,
Go ahead if you go ahead, Schreier. And then the other one, Schreier, if you'd missed, was about the best and worst deal in the last since. So maybe if you talk about best and worst deal, that'll also answer the risk of investors.
It's okay. Oh man, that's so best deals. So I'll give you my bandwidth, then we'll go from there. Trevor, you have done quite a bit as well, so I'll give you a flavor of the both residential land and the multifamily side, and also the warehouse side, and then I'll give you the worst, right? So worst in a sense, most of the time, as of now, exit perspective, I have done personally over 260, 170 transactions where I bought and sold personally. From there, about 250, 260 of them are residential and land, and about 17, 18 multifamily deals. On the resi side, I lost money in one. That's because flood happened. That's beyond my control. And I walk away with about 6 properties with a break-even price. That's because I had a structural and a mistake where I was too busy. I didn't put my eyes on the deal, so margin wasn't there. So from the resi side, my strike rate, thank God, is good so far. So one loss on that one. On the commercial, and then the commercial side, I personally transacted over 7 warehouses, and my 5th one is so far has been the toughest one. So it checks out all the boxes, but then I caught with the local subculture. What I meant to say, every real estate is zip code by zip code. I mean, I meant by street, block by block. It's a grassroots battle, right? So I bought an asset in Baytown, and right behind the Exxon refinery, I bought a warehouse, and everything checked out from here. I drove by, everything is good, but I didn't realize that street is totally different than the next street. It was a little over $500,000 deal. And then I got a new broker. That person didn't do due diligence. I got a professional tenant. So I own the building right now for almost 3 years. I got paid only 3 months of the rent. So then God says, Shariah, thank you. He sent a tornado. I'm in the positive with that note. So my worst deal from decision-making perspective is that where system worked out, but the people in the system, they did not do the due diligence, this investment decision was bad. Similar pattern happened in the multifamily side. Is if I look at the worst, we haven't sold anything. So I wouldn't say, anything was bad. Market took a hit. Yeah, if we sell it within next this year or so sometime, we'll take a 10 or 15% haircut. But that's, to me, it's like not our performance. Our revenue is out of, at least 2-3 years out of forecast. But the biggest learning, the toughest one I had, is the one I did on the Pasadena. Our first deal, we thought, I'll give it to me and Sanjay, finance, his Chicago booth, I'm right. So we're like, we got it. We did all sorts of modeling. Modeling says we buy the asset in 2022, that 6 cap or 6% rate cap will hit it, last year, April. God says something different. He says, Shariah, son, here you go, that's your gift. We didn't even collect our first check. We hit our rate cap, 6%. So, our interest payment went up to $19,000 within less than 27 days. That was one of the toughest one. And on top of that, we found out some of those stuff in the sponsoring team. The team says who they are, but they weren't. So we had to take over the deal almost within a month. So here we come at KP. We invested our own money. 40% of the whole check was ours, personal. So we go back in and we are being active. We're new. From there, within 30 days, we're running the deal, right? That was the toughest one I have done. So damage control was real. From there, the stuff that we have done into that place, it was so much of a learning and fun. But thanks to Sanjay, right now we're in a good spot, no issue. But the learning that we had, it's the people, personality, local subculture, then the interest rate, then the tax increase, then the insurance increase. It was like one after one after one, right? But right now the deal is in the positive, and we break even, we make money, and then we have a refi coming up in September. We're taking a hard loan. We calculated how much of a cash we need to inject into this deal, so we survived quite a bit. So for my worst in terms of the intense amount of learning will be that. The second one we did is on the McCollum one. It's a 419 units. It's a different beast. Running a 50 units is piece of cake. You can turn that thing around in 7 months or less. Up to 150 takes about a year and a half. But we didn't realize that once you get a 400 or 350 and above, it's a big ship that you have to turn. It's slow, takes time, it's a structural, and you need every single tool in your toolkit to kind of deploy to get ahead, right? So that was really good interest. And the things that we have done right, we had a low interest rate. We had a long 7 years hold. 7 years fixed. Then we had a high pref, so you have a low burden to pay out. It worked out. We slipped quite a bit. One of the things we learned that every decision that we make at the property management level at that size takes about 4 to 5 months. That means if we let go a property manager today, we bring one tomorrow, it takes about 3-4 months of efficiency. You go back in time. So our decision is you hire fast, but the fire faster. And now it turned the ship is going to the right direction. That was our second intense learning in terms of a bad deal. So hope this one helps. But we learned quite a bit. Extreme amount of learning, AI, bots, tools, focus, structure. Those 2 deals helped us to get our own asset management software. Now we can take over an asset in 3 days, and a whole bunch of other stuff as you can have done it on those 2. Back to you, Mike.
Awesome. Good answer. Good answer. No, and I wanted to share with Varun and any others. So the link that Trevor shared for the IRA does come to this page, but you either put in your name and email and you access here to get to download the book, or you can go to one of these links and it's going to bring you here to just put in your quick information and then access to download the book. I hope that helps, Varun, for what you were looking for.
Yep. Thank you.
Hey guys, I've got a question.
Yeah.
Can you give, I appreciate y'all's time and the information you guys are giving tonight. It's been very helpful. Could you give a brief overview of, the landowner scenario that you guys discussed earlier?
You,
Like the
you want to
JV
start,
partnership?
Shreyer? You want to go first?
Okay.
I don't,
So
slowly.
got it. So what we do from Realty One and Massive side of it, we have built quite a bit of a ground up retail development, also town centers, and also mixed use multifamily, right? So in Fayette, Texas, we have one, then we're building another one, and the R1 has done quite a bit of retail for the last 40 years. And we just finished the town center in Montgomery County, and we bought 11 acres in Katy to build commercial town center. So what we do now, if a landowner has a piece of property that checks all the parameters of new construction, then we say, hey, landowner, you come in with the land and JV with us, and we are going to pick it up from there, bring in the capital for the entitlement, take the debt on the construction, finish the construction. We have a team to lease up, so we'll do the lease up, then we do refi. Once we do the refi, everybody takes their money back out, and then we split the cash flow as we go. And that's the partnership model that we're doing. It helps for the landowner in a couple of different ways. Right now, land price is lower than the market. So if I have to buy a land out today, I have to reduce the price 20-30%. So by JVing, landowner takes an optimal price. They don't have to take the haircut. They get a little bit higher price, right? That's number one. Number two, as landowner stays with us, we are paying them somewhere between 15 to 20% IRR on the investments, right? So not only they get paid one time with a higher price, but also the LP investment keep on making money throughout the construction, right? And then they get out and they're deferring the tax from the first sale. So they get paid 3 times tax deferral, the LP investment return, and a higher ticket time, higher price with the landowners. And they don't do anything, we do everything else.
To clarify, we're looking for A-class properties, like we're not looking for sand out in West Texas. We're looking for Dallas, Houston, Austin, San Antonio, core markets in the path of progress.
Did that help? Or is that what you're looking for?
Thank you.
It's a good way to create a win-win.